My name is Jake, welcome to the channel. In today's video, we're gonna do a Review My Pie video where I review subscriber portfolios. This is one of my favorite series on the channel. I've been doing it for, I think like five years or so. And I like this video series because it's different than the other videos on my channel because I see it more as a conversation. As if you and I were just sitting down together, having a conversation, and we were talking about dividend investing or investing as a whole. And my goal for creating these videos was to help normal people learn about dividend investing, learn about financial independence, and how you can use your dividend portfolio to reach financial independence, whatever version that may look like for you personally. So when you're new to something, it might feel a little bit overwhelming, right? When you're learning a new skill, a new task, it can sometimes feel overwhelming, or in some cases, impossible. I remember when I was first learning to invest, I made all the mistakes in the book. Nowadays, you have so many resources that you can, pull from and learn about investing or anything that you're interested in. But the important thing is to never give up and to keep pushing forward, no matter how challenging or frustrating it can be. So whether you're learning to change a flat tire, change a faucet, or learning how to invest, some things come easier to some people, and some things just simply come harder to some people as well. And like for example, watching my wife parallel park. For whatever reason, it just hurts. It doesn't hurt her, it just hurts me to watch. And but regardless of how much it hurts, I guess we all have to start somewhere. And well, I guess it could look a little like this.
Oh, don't you be acting a fool. There. Oh, well. What the hell are you doing? I know you're fine. What are you doing, dude? You are not bleeding. I did not have you out of the water long. Good either way. Oh my gosh. You're so dumb. You're the biggest dumb fish. Come on. Okay. We're out of the cove. There you go, buddy. Or not. What is wrong with you?
Oh man. All right, cool. Back to business. All right, cool. So a lot of you have been asking for this. I haven't done this in a while. This is the, you can book time with me. I used to do this here last year and the years before, and a lot of people really enjoyed this, and I haven't had time this year. And so I wanted to bring it back. I'm now doing this once a week. I blocked off my calendar. If people want to meet with me here on Sundays going forward, you're welcome to book time with me. This is what I did in the past is I'd meet with people for an hour and, just talk about their situation. If they're looking to retire off their dividend portfolio or they have questions around, different investment, strategies or accounts. I don't offer professional financial advice. I'm not a financial advisor, but if you want to book time with me, talk about your portfolio, talk about your strategy, I do offer this once a week now. It's all via Google Meet. I share my screen, I share my video if you want to, meet, in that way. If you're interested in booking time with me, I do offer that once a week, and I'd be very excited to meet you. So in today's Review My Pie, we're going to take a look at one question and three portfolios. The question's from a 22-year-old here in the US. The first portfolio is from a 19-year-old here in the US. The second, a 29-year-old here in the US. And then the third, a 48-year-old here in the United States. So a lot of them here in the US. If you're outside of the United States, send me over your portfolio. There's an email in my description of this video. You can send me over your portfolio. I'd be happy to review it. I try to include different age groups, from people from different countries. So if you're outside of the US, please send me your portfolio. I'd be happy to include it. And as always, everybody, the timestamps will be in the description below, as well as the portfolio links will be in the description below. And as always, everybody, I'm not a financial advisor. Please don't take what I'm saying as financial advice. This is just merely for your entertainment. But before we get into the portfolios, I want to take just a minute here and share with you about today's sponsor, Snowball Analytics. I am so excited that Snowball Analytics is sponsoring the channel, and I thought to myself, what better way than to show my portfolio and give a portfolio update than in Snowball Analytics here. I've been rebalancing my portfolio here this year in 2025. If you're new to the channel or if you haven't watched a few of my videos recently, before last year, I was following the core and satellite approach where I had a core portfolio of ETFs and a few satellite positions. I've kept the core and satellite intact, but instead of having individual stocks, I'm having just ETFs. So I've consolidated my portfolio all into 4 ETFs in SHD, JEPQ, JEPI, and DGRO. So currently SHD holds about 53% of my portfolio. Over half of my portfolio and just under $1 million is invested into SHD. And the next is JEPQ. I have about 34% of my portfolio in JEPQ. And just to do a really quick recap, earlier this year, when JEPQ was falling in February, March, April, I started rebalancing more so into JEPQ. Hindsight 2020, I wish I would have bought more DGRO as well, but I got a little bit overzealous, I guess, excited, I don't know the word here, excited with JEPQ, seeing the dollar signs. And so I went really heavy into JEPQ. And in JEPI, I've not added anything this year. I'm actually planning on rebalancing out of JEPI and adding GPIQ, a video that an ETF that I talked about a couple of weeks ago. And DGRO is just sitting at around 5%. Now, DGRO is a smaller position of mine because I'm currently living off my portfolio today. If I was in my early 20s, this would look entirely different, where I'd have probably the majority of my money invested into DGRO, actually. But because I'm living off the income today, I want more of a higher starting yield, and that is why. But long term, once I get to a point where I can reinvest my dividends, I will probably invest a little bit more into DGRO going forward. I hope so. I just hope that I can get it around a forward dividend yield of around 2.5%. So I'm being a little bit selective of when I'm buying DGRO. But if I was in my 20s, I'd be dollar cost averaging every week, every month into DGRO. But that's just me personally. So the portfolio is right at around $1.8 million. The current yield that I have in this portfolio is right around 6.5%, and the portfolio is currently generating $120,000 a year. The reason why this is so high relative to the balance is because I went so heavy into JEPQ, and that has to do with no longer working my 9-to-5 job, and so I'm actually living off of the income from my portfolio. One of my favorite features here in Snowball Analytics is seeing your yield on cost for your portfolio for each individual position, as well as for your entire portfolio. So you can see here my yield on cost for JEPQ is just under 12%. JEPI is a little bit below. JEPI has just kind of been stagnant, ever since I bought it years ago. It's really not done anything. It's been more of like a bond, I guess. SHD, the yield on cost with SHD is much lower now because I've rebalanced at a much higher price. When I was buying SHD in 2019, I think I was buying it at like $19, something around there. And so my yield on cost has gone it's gone down a little bit. I think I had a yield on cost a little over 4%, I believe. But because I've rebalanced new money into this, the yield on cost is a little bit lower. And DGRO, I haven't really added much. I have just under a 3% yield on cost on DGRO. And the feature that I use the most with Snowball Analytics is the dividend calendar. I use this on my phone all of the time when I see, I want to see what dividends I'm going to be getting paid this month. So when looking at the month of September, I'm going to be getting here about $1,000 in JEPI, just over $6,000 in JEPQ, and then just over $500 in DGRO, and almost $9,000 in SHD. With SHD, I have 35,000 shares in SHD, so quite a bit invested, just under $1 million. And the portfolio, it's generating about 120,000. And you can see here, the largest payouts are in September, December, when those quarterly payouts are coming out from SHD primarily. And then lastly, I want to show you this really quick. This is a tool that you can use to build a hypothetical portfolio. Let's say, for example, you wanted to build a portfolio of DGRO, SHD, and let's say you wanted to include a covered call ETF like JEPQ. Let's say here. Okay, so let's say you had 50% in SEHD. Let's say you had 30 in DGRO and 20 in JEPQ. And so what you can do is, all right, well, you want to forecast potentially into the future. Let's say you're 20 years old and you want to retire at the age of 40 and you're projecting to retire with $1 million, right? Let's say you're going to retire with $1 million hypothetically. And if you invested into SHD, DGRO, and JEPQ as your final allocation, right? You may adjust that over time, right? Which I would actually recommend treating it kind of like a target date fund where you adjust these these percentages, the weightings as you get closer to retirement. But let's say hypothetically, in 20 years, this is your end goal of 50% SEHD, 30% DGRO, 20% JEPQ, and you're at the age of 40, right? Because you still want this portfolio to grow and to compound. You can see here that a portfolio like this is going to have about a 4.5% dividend yield, and you're going to get about $45,000 in annual dividend income. And you can see here, run this scenario of what this would look like. I wish I had this when I was building my portfolio, but this is another, let's say, for example, well, Jake, inflation's a thing. We're going to need, $5 million. It's all subjective to you and your individual costs and your expenses. But if you were to say, okay, well, I want, $1.5 million with the same parameters, but now you're getting $68,000. And you might be thinking to yourself, okay, well, Jake, let's take a look at the dividends. What dividend income am I going to be, generating from a portfolio like this? That's why I love Snowball Analytics, because you can drill into the analytics of your portfolio and what it could potentially look like. But let's look at another example. Let's say, you're going to get a little bit greedy, and let's say you want more covered call ETFs, greedy in the sense of yield, I guess, or excited for yield. I don't know. Let's say you went 15, and you went 20, right? Let's say you lowered DGRO and had, a little bit more in covered call ETFs. What could that potentially look like? Well, it shows you what your income will look like based off of your portfolio allocation. So guys, this is why I love partnering with Snowball Analytics, because the value of this tool is incredible. They have a free version, they have a paid version. If you use my link in the description below, you will get the very best pricing. I negotiated with them. So I've been partnering with Snowball Analytics for over a year. And I requested that they pay me less when someone signs up with my link so that I could offer a greater discount. If you use other people's link here on YouTube or anywhere else, you're not going to get as high of a discount as you will with my link, because Snowball Analytics and I agreed that they would pay me less when someone signs up so that I can offer a greater discount when you use my link. So with that, everybody, thank you so much, Snowball Analytics, for sponsoring this video. And now let's get into the portfolios. All right, let's take a look at the question here. It is from Cameron. Cameron writes, "Hi Jake, hope all is well. I'm Cameron, I'm 22 and from Utah and hoping to retire early off dividends in my 30s or 40s. I don't have any health issues, but you never know. Every month, I send what I have to a high yield savings account for a house or to stocks, switching every month unless my IRA is open, which I max out as soon as I can. I'm usually saving $1,000 a month. That is on top of investing $620 a month. That's awesome, man. You're doing $1,600 a month. That's great, which is more than 15% of my monthly income. I heard about health savings accounts and found they provide tax benefits along with their normal benefits. Contribution limits are $4,300 because I am single. Should I max out an HSA after maxing out my Roth IRA? I believe that will leave me with more than 6 months of investing in house savings outside of my Roth IRA and HSA. I think it's a great idea, but I'm curious what your insights are and if you have any recommendations I haven't considered. Thank you, and I look forward to your videos every Sunday." Well, Cameron, thank you so much, man. I really, really appreciate it. I'm up here in northern Utah. I'm born and raised in Utah. I spend part of my time in Utah and Texas, but this is a really great question. So first off, I want to touch on this 15%. You're 22 years old and you're already contributing 15% of your income towards your goal of retiring early. I absolutely love the fact that you're considering that this is part of your monthly income. When I was 22 years old, I was thinking about leveling up my mage in WoW. Like, I wasn't thinking about, retiring early. I think this is absolutely incredible. So one tip that I would give you is to continue looking at it from this perspective of how can you increase your savings rate? Your savings rate, how much you're investing up to, maybe you can get this up to 30% next year and 40% the year after. Or maybe you could get it up to 50% in 5 years, because that's what's going to move the needle. And so that you're going to be able to contribute more to your HSA, more to your Roth IRA, and then more to your taxable brokerage account, because you want to leverage that before the age of 59 and a half. So to answer your question, in my opinion, I think you should max out your HSA first because of the tax benefits that come with an HSA. You get triple tax savings with an HSA. And so the HSA, in my opinion, would be the first one that you max out. If you had an emergency, you can access the HSA more easily than a Roth IRA. There's less restrictions because, emergency, you could lose your job. You could have a medical expense. You even talk about medical in the email here. So that's on your mind. So I think HSA would be the best bet, in my opinion, simply because of the tax benefits that you get with it and the flexibility that comes with that. Okay, and so HSA, absolutely, Roth IRA. And so what my wife and I did, and this was not by design, but we just kind of did it it just happened this way. Earlier in our careers, we maxed out our Roth IRA, our 401k, and our HSA. We didn't really invest a lot into our individual brokerage account because we didn't really know that we wanted to retire early. You, on the other hand, know that you want to retire early. So what we did, it was kind of a blessing in disguise because we front loaded our retirement accounts. And then towards the last 5-6 years of working, we then really went gung-ho on maxing out our individual accounts, right? And so we front loaded the retirement accounts. And then in the last 5 years of trying to pursue FIRE, I didn't even invest into my Roth IRA or 401k. We always every year maxed out our HSA. We always did that. But that was part of our overall strategy. So you're on the right track. I absolutely, think you should max out your HSA, your Roth IRA, whatever makes the most sense for you. But don't neglect your taxable account, in terms of the planning. In the beginning, you could go the first 3 or 4 years and not invest a single dollar because you don't have the money yet into a taxable account, and that's completely fine. Even if your goal is to retire in the next 10 or 20 years before the traditional age of 59 and a half. So there's many different strategies of how you can go about this because you're different, because you're not looking to retire at 59 and a half. You kind of have to look at this a little bit differently than you would, had you, worked into a pension, right? You're working towards a pension or something like that. So you're in a very different situation. I made a video on, the different types of accounts. This video is like 4 or 5 years old, but it still is applicable. And in that video, I break down all of the different tax benefits of each account that you can invest in here in the United States. So definitely worth taking a look at. It is a little bit older, but I would highly recommend it. But yeah, Cameron, thank you so much for sending over the question. I think you're in a great spot. All right, the first portfolio is from Alexandra. I'm so excited. We got a girl watching the channel. I think I look at the YouTube statistics, 98% of my viewers are dudes. So it's so great to see, a female viewer of the channel. So Alexandra, thank you so much for watching. Let's take a look at it. So good evening, Jake. I hope you're doing well. I'm a 19-year-old college student, and my long-term goal is to eventually live off the income from my investment portfolio by my late 20s. I'd really appreciate your insight. Would you suggest any changes to my current strategy? If so, what would you recommend? Thanks for your time and guidance. So, the first thing that I would tell you is if you're planning on retiring off your dividend portfolio, it's much more than just the investments in your account. Like we just saw with Cameron, it's kind of, there's two important things. It's important to understand what you're investing in and where you're investing, right? Where you're investing is in which account are you investing? In a 401k, Roth IRA, HSA. What is your strategy around that piece? And then the next piece is what you invest in, what ETFs, what stocks are you investing in? So you're looking to retire in the next 10 years. So you want to invest in your late 20s or early 30s. That's, absolutely achievable, but it's going to take a lot of dedication and, discipline to be able to do that, because you're not the norm. Retiring in your late 20s means that you're not normal, right? Unless you got fed with a silver spoon, you're getting an inheritance or something like that. If you're doing this through blood, sweat, and tears by yourself, through working a 9-to-5 or side hustling, this is going to require a lot of work and dedication from a 19-year-old, but it is absolutely possible. But there's a few things that you want to make sure that you're aware of, and you're not just looking at what you're investing in, you're looking at where you're investing your money, what you're investing in, and then also looking at, well, what are your anticipated expenses, right? Because that's really where you want to start. You don't want to start, okay, I want to retire in 10 years. Well, you want to start with, okay, well, what are my expenses likely going to be in 10 years? Is it going to be 50,000, 70,000, 100,000? 200,000? Where are you going to live? What are your expenses going to be? And that's where you want to start, is work backwards. In 10 years, what will my life look like? And then you want to mold your strategy based on that. And that's why I like, referring back to the Snowball Analytics example, right? Where you're thinking, okay, I need $100,000 in dividend income and adjusted for inflation, right? So what kind of portfolio is going to get me there? And those are the questions. Those are the things that you want to start thinking about, not just which stocks go up, right? Like which stocks are good, right? Which ones are green and which ones are red? Which ones do I buy? Which ones do I sell? That's only a small piece of it. And so I hope that by sharing this, it kind of opens your mind to a new way of thinking, because that's really what I'm trying to do here, is help you to learn how to think about this and not what to think. All right, let's take a look at your portfolio. So it looks like you got a handful of positions in here. You got 19 positions. It looks like you're following a core and satellite, which I talk about. I love this. Okay, so let's take a look at it. So you got 25% in DJRO, you got 25% in SHD, you got 15 in JEPQ, and 15 in JEPI. Okay, so we're going to touch on these very heavily in a moment. You got Texas Roadhouse, you got Costco, Apple, SPGI. This very much looks like it's influenced by Joseph Carlson and myself. This is like if Joseph Carlson and I had a baby, this is what the portfolio would look like. So shout out to Joseph Carlson. He had a really good influence on you. Okay, so cool. So you got some really good companies in here. I love your strategy. You're following the core and satellite. I think this is great. So the screaming red flag for me, I think you're probably going to know it. I think the majority of you know it. You can write it in the comments and see if you can flex, you know what I'm going to say. Before I get to that, the first thing that I want to say, I want to give you really positive feedback. The positive feedback is that you're taking what I'm saying, because you obviously follow my channel, is you're following the core and satellite. You're going heavier in dividend ETFs, high quality ETFs, and you don't have any individual stock at more than 5%. So if you were here, I would give you the biggest high five. What I would tell you is the cover call ETFs. You have a 10-year time horizon. You don't need the cover call ETFs. Now, what I would recommend, you're going to have to judge this for yourself. I wouldn't go and just immediately sell them. What I would do is I would put these to 1%. I put JEPQ and JEPI at 1%. Okay. And I wouldn't add any new money to JEPQ and JEPI until you get at least 5 years before you're planning on retiring. Ideally more towards 3. So imagine you're working for the next 10 years. You're just setting this on autopilot. You're treating this like a target date fund, where as you get closer to retirement, you're adjusting the allocation. Okay. So this portfolio would be great in 10 years, but as you're allocating new money to it, it would be more efficient and more optimal to optimize it a little bit more for tax efficiency and more for growth potential. It's all about the potential, growth potential with these cover call ETFs. Okay, so that's what I would recommend. Put JEPQ, JEPI at 1%, and I would not, in your dividend yield is likely going to go down to like 3% or 3.5%, but that's completely fine. You don't need a 5.5% dividend yield now. Once you get closer to retirement, then you can increase JEPI and JEPQ, and by increasing that, you will adjust your dividend yield, but also your dividend growth rate, because they're inversely correlated. Yield and growth are inversely correlated in almost every case. Okay, so it's important to understand that. And so, in my opinion, what I would recommend is I would then take that 28% that you're getting here, and I would just throw it into DGRO and SEHD. And then as you get closer to retirement, as your goals become clearer, I would then adjust and then, add a little bit more to these covered call ETFs. If you really like, one of these other stocks in here, you could add maybe 1 or 2%, right? But that's how you want to look at this, is truly like a target date fund. And I talk about this in the dividend growth pyramid. If you've seen that video, I talk about how to invest based off of your investment time horizon, how you want to look at dividend growth rates and yield, and how they can complement your strategy based off of your time horizon. I'll have that video pop up at the end of this one. It's one of my favorite videos that I've made on the channel, but I think it will really help you. But Alexandra, I think you are in an incredible spot. And I think, you're moving in the right direction. It's just now focusing on those other things that I mentioned to round out your overall strategy of how you're going to make this dream of retiring early off your dividend portfolio a reality. Thank you so much for sending over your portfolio. The next portfolio is from Zeke. Zeke writes, "What's up, Jake? I'm 29 years old and I just started investing. I'd love to retire at 55 years old and I invest about $500 a month. I'd love to hear your opinion on my portfolio. Any recommendations would be greatly appreciated. Thank you." Well, Zeke, thank you so much for sending over your portfolio. You're 29. 29 is right around-ish the age when I really started taking my investing seriously. I was living in Germany. I was going through a breakup. New life, new experience. Everything was kind of new for me, or kind of starting over. And so 29 years old is a great time to think about investing. I want to say restart, or view investing, I guess, as a whole, because I look at my own experience and that's how I did it. I started really, obviously I put myself in the position, because I didn't have any student loan debt. I didn't have any debt. But I didn't really, my net worth was like zero. I didn't have anything really. And so I started out at 29. And in 10 years, I was able to grow my net worth pretty significantly through my W-2 income, through real estate. There's many ways that you can do it. But just, I see the 29 years old and I kind of get nostalgic with that, because that's when it's all started for me. But just purely looking at your portfolio, let's take a look at it. So you got 40% in the Schwab S&P 500 ETF. You got 20% SEHD, 20% in DGRO, 10% JEPI, 10% JEPQ. So you got about a 25-year time horizon. This is a really good time horizon. And let me talk about your portfolio, what I like, and some things that you're going to want to consider. The thing that I really like is 25 years is a long time, okay? And so having 40% just in the market is a really good idea, because you don't know what's going to happen in the next 25 years. I don't know if you're married. I don't know if you have a house, because life is going to throw you a lot of curveballs, speaking from experience, because looking back, before I was 29 and after 29, my life changed so much. But the thing that I like about 40% into the S&P 500 is it gives you flexibility. You don't have to have all the answers. 40% of your money is there. Let's say, for example, in 3 years, let's say the real estate market flips, you get married, you have a kid, and you want to buy a house. You could sell a portion of your portfolio of the S&P 500, and you can use that as a down payment. You're flexible. With SEHD and DGRO, you want to see those as kind of like real estate, right? Where that's your rental income. I always look at investing from that lens, investing in for growth, with, flipping a property, or investing into a rental property where you're focused on the income. That's kind of just how my brain functions, how I think about things. But with SHD and DGRO, you want to look at those as you're never going to sell them. Whereas with the S&P 500, you're likely going to sell them. So you want to view your portfolio from that perspective. Now, with JEPI and JEPQ, my opinion, you could bring those allocations down to 1% or get rid of them entirely. 25 years, you'd be much better off just holding the NASDAQ statistically and historically, because I'm focusing on, these covered call ETFs, they cap the upside. So you'd be much better off holding the underlying index of the S&P 500 with JEPI and the NASDAQ with JEPQ. And then in 25 years or shortly before you plan on living off your portfolio, rebalance and then buy them. So that would be, if you were sitting here, I would try to convince you to reconsider that. Obviously, you're going to do whatever you're going to do, but I would try to convince you to ignore JEPI and JEPQ. Your dividend yield will go down, which is probably a good thing because you don't need the dividend today. Why do you need to pay taxes on it, right? So you want to make sure that you're viewing this from a tax perspective, talking about it, how can you optimize this? And that is a very easy win, just in my opinion, to remove JEPI and JEPQ for now. Treat this like a target date fund where over time you're going to adjust the percentages based off of your goals and where you're at in life. So it's pretty cut and dry. That's how I'd view this. I would look at your portfolio from the lens of what are you going to hold forever? What are you going to potentially sell in the future or rebalance? And then invest accordingly. In my opinion, I kind of like the idea of separating these. If you had two different portfolios, say for example, you had one in M1 or in Fidelity or Vanguard or Robinhood, wherever, have a growth portfolio in one account and have a dividend portfolio in another account. I personally like that. That's kind of how my OCD brain works. I like seeing them separately and because their goals are separate, right? It's the same reason why I like having a high yield savings account in a different account because it has a specific purpose. And that's just how I do it. But it helps me to categorize what each account, what's the goal of each account. And, I would also recommend if you listen to kind of what I was talking about with the other portfolio, understanding, about different accounts, the goals and strategies behind there. But as it stands, it's really just adjusting your portfolio as you get closer to retirement and optimizing for tax efficiency and controlling what you can control. But with that, Zeke, thank you so much for sending over your portfolio. I hope that was helpful. All right, let's take a look at the last portfolio from Ozzy, Rip Ozzy Osbourne. So Ozzy writes, hey Jake, I updated my portfolio and narrowed it down a bit. I'm 48 years old, and in the next 10 years, I want to stop working at around 59, hopefully. I have a Roth IRA handled by a financial advisor at $7,000 a year. In addition to a Roth, I'm putting $2,000 a month in the stock market. $1,000 of that goes into SPLG, that's the S&P 500, SHD, and SHG. SHG is a growth ETF. Equally and automatically per month, $1,000 goes into the stocks that I choose per month. So I'm hoping to have an extra cash flow during retirement, hoping at least $2,000 monthly extra income in addition to my other incomes. It is hard to decide a strategy when you're 48. You don't have much time for growth strategy. However, you can not go full defensive either. You're 48, you got 10 years. 10 years is an entire economic cycle, right? You could see the market go up 200% in 10 years. So, or it could be completely flat. And I guess that's what he says, which is hard, which he's not wrong. But, the market goes up more often than it doesn't. But it's challenging. I would like to get your opinion. What is the best way to get cash flow in 10 years with my numbers? I have $80,000 as of February 2025. My portfolio screenshots are attached in this email. Thank you for your time, Ozzy. Okay, well, Ozzy, thank you so much for sending over your portfolio. Ozzy, you're the person that I'm talking to, right? When I'm talking about, when I make my videos, I'm thinking about you. I'm thinking about you, someone like you in your position, because I was in your position 10 years ago when I was 29, right? Thinking about, well, what do I want to do? How do I want to invest? How am I going to reach my goals? Unfortunately, when I was 29, I didn't have, somebody that I could just talk to or watch videos like this that would help me to understand how to invest based off of my investment time horizon. So first, what I'm going to do is I'm going to approach this mathematically, and then I'm going to take a look at your attachments with your individual holdings. So you need $2,000 a month times 12. So you need $24,000 after tax. So you're talking about a Roth IRA. I don't know if you have a 401k or, a retirement account, a pension, but what I would recommend, because the very first thing before you do anything is first understand where you're investing the money, in which account, right? We've talked a lot about that in this video, but I would first recommend, because you're going to retire after the age of 59 and a half, every dollar that you invest should go into a tax sheltered account, HSA, Roth IRA, 401k. And by doing so, you're in the lucky position where you don't even have to factor in taxes. So this doesn't have to be adjusted for taxes. So so those are the things here. You're going to retire at 59. I'm assuming that you're going to have all this money invested in a tax sheltered account. So you need $24,000 in the next 10 years. So what you're looking at is, okay, if I invested, let me use a few examples. If you invested, let's say 50% SHD, 50% DGRO, that's going to give you a weighted average portfolio yield of 3%. So you take your 24,000 and you divide that by 3%. That means you're going to need $800,000 in the next 10 years. So you might be asking yourself, well, can I grow the portfolio with my contributions and from the growth of my portfolio in the next 10 years? I would probably say that's going to be a little bit difficult. So we know that that's going to be difficult. Maybe we adjust the strategy. So instead of going 50% SHD, 50% DGRO, which will give you around a 9 or a 10% dividend growth rate, by the way. So that yield, that 24,000 would be growing at about 10% a year. Well, if $800,000 is not feasible, then maybe we should consider, juicing up that dividend yield. Maybe we included a covered call ETF, like a JEPQ. Let's say, for example, you lowered DGRO and you bumped up JEPQ, and let's say you were able to get a 4.5% dividend yield. So you take that same 24,000, you divide that by 4.5%. Well, that's going to give you right around $500,000 that you're going to need in your portfolio. You might be thinking to yourself, well, Jake, that's still too much. I can't do it in 10 years. Well, you have two options. You can either prolong the time, or you can change your portfolio. So in this case, let's change the portfolio. Let's say you went like 40% JEPQ. Let's say you got a covered call ETF like JEPI as an example at 10%. So let's say you had like 50%. I don't really recommend this, but let's say you got like 50%. You could say that your dividend yield is, let's say, 6.5%. So you take that 24,000, you divide that by 6.5%. Well, now you're looking at about $370,000 of invested income or portfolio capital to generate that income. This is how you look at this, okay? But what you want to not forget is a portfolio where you're going to have about half, 40 to 50% in covered call ETFs, and then the other, 50% in SHD and a little in DGRO. You're going to have a lower dividend growth rate. Your dividend growth rate might go down to about 4 or 5%. So that's something that you want to factor in. But that's probably okay for you because you're 59, you probably have a pension or Social Security or something else to rely on. This is more so you need the income now. Whereas maybe if you were, 45 and you had another 30, 40 years or however many years, maybe that the dividend growth would be more important to you. So it's really a balancing act of what do you want? Do you want the higher income today, lower growth in the future? Or do you want lower income today, future growth, future dividend growth in the future? So they're inversely correlated. So it's important that you answer the question for yourself. What's important to you? How do you reach your goals? So Ozzy, this is how we look at this. You look at this from a mathematical standpoint. How do you make the numbers work for you? And then what you do is you understand, okay, every investment is going to hold a different measurement in this equation. How do you make the numbers work for you? And in my opinion, it's much easier to do this with ETFs than it is with individual stocks. But, to each their own. Everyone has their own approach. But I recommend doing this with ETFs because it's just easier to figure out the numbers. All right, so let's take a look at your portfolio. You currently have, I like how you have this set up. You have core, you have growth, you have REITs, dividend stocks in here. So you got the S&P 500 at 13.5%, SHD and SHG. You got Microsoft and Google. I don't think you need so much in Microsoft and Google because you're going to have quite a bit of overlap with Microsoft and Google in SHG and the S&P 500. I think this is kind of a little bit too much, me personally. I would lower this probably like 2 or 3% simply because you have a growth ETF anyways, and you're getting a really low dividend yield, right? So if your goal is to live off the income. Realty income is also too high in terms of a target. Now, $8,000, $9,000 is not really going to move the needle in terms of your goal of $24,000. But as you get more invested, I would adjust this. I would include a separate column. I would have current allocation and I would have target allocation right next to it so you know what you're working towards, okay? And so then you got some other individual dividend stocks in here, Pepsi, UPS, BTI, stuff like that. So what you're going to want to do, a lot of these are really good companies, and I'm not going to go in and individually assess each individual stock, but what I would say is I would focus on making the numbers work for you. The advice that I would give you and anyone in your situation is look at your portfolio holistically. Look at the weighted average numbers. What is the weighted average dividend yield of your target portfolio? What is the weighted average dividend growth rate? And you can use, Grok or ChatGPT or whatever to calculate those weighted averages, or just do it the old school way in Excel like I do. But what you're going to want to do is you're going to want to calculate the weighted average portfolio dividend yield so you can get those numbers. Remember what we were talking about earlier? How can you get a portfolio that is yielding 5%, right? So that you can reach your goal, right? So that's how you want to look at this. You want to not just look, you want to look at the individual stocks and ETFs as merely a vehicle. How can that vehicle get you to your goal? And that's how you look at it. Don't be emotional. Don't, look at each of these stocks and marry your stocks. Look at them objectively. How can my investments get me to my goal? And guys, I don't talk about this a lot, but that's why I sold all my individual stocks. I don't really care as much about which individual company I'm investing in. Individual companies are nothing more than just a business. They make mistakes. They're not perfect. I would much rather own a basket of stocks based off of an index of the rules of an index that I am interested in, right? And it makes my goal of retiring off of my dividend portfolio so much easier. Now, I will say with one caveat, it is easier to get a higher portfolio weighted average yield in combining individual stocks because you can add a BTI or a SIN stock with a higher yield. But I was able to do that with a covered call ETF like JEPQ, right? So that was my approach. So what I decided was, well, you know what? Instead of investing into like these SIN stocks like BTI, Philip Morris, Ultra Group, I was like, you know what? I can get that 9 or 10% dividend yield, though it's not qualified and maybe not growing as quickly. I can achieve my goals with a covered call ETF like JEPQ because I want to live out the portfolio today. And that's how I rationalized condensing all of my individual stocks into ETFs. And it just makes your life so much easier. Now, I do want to throw out there that I'm not anti-individual stocks. I just have seen the light and I just see how much easier life is. But I do, it is kind of cool being a shareholder and owner of Realty Income. When you go to a Walgreens, you're like, hey, I'm a partial owner of this. So I get it. Or when you buy a Coca-Cola, it's like, hey, I'm a shareholder. I get that. But merely from an objective standpoint, for me personally, it was just so much easier. But you got to do what works for you. Ozzy, I hope that this helps. I hope that you understand what I'm saying here is you're trying to solve a math equation. make the numbers work for you. And everyone out there watching, make the numbers work for you. Don't overcomplicate it. I'm living off my dividend portfolio today. Mondays, Tuesdays, I go hiking. I spend time with my son. I don't work a 9-to-5 job anymore. I don't want my retirement of living off my portfolio to be stressful. And a way that I do that is I invest into ETFs. But that's just me. But yeah, thank you so much everybody for watching. Thank you Ozzy for sending over your portfolio. If you haven't already, go check out Snowball Analytics. Thank you Snowball Analytics for sponsoring this video, and I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.